Can we take the roll, please?
For the treasurer, Mr. Boykin. Here. For the director of finance, Ms. Ortega. Ms. Higa. Here. For the controller, Mr. McGuire.
Here.
Chairperson Rosensteel, you have a quorum.
Thank you. You're ahead of me. I have to get the agenda up here. So, welcome everybody, and the first item of business is to approve the agenda for today. Do I hear a motion? All in favor? Aye. Good, it's approved. We are, just as one note about how we're going to go through the agenda, we've got a number of related items, all related to the audit, and different documents. We are going to go through them individually, because in discussing how to go through the agenda, we decided if we went through everything and then tried to do a approval, we might forget, but to ask the questions about the one that we want to ask a question about. So we'll go through the agenda, take each item separately, but they are interrelated, and we will get, I think, a presentation that encompasses more than just one document at a time. So with that, the next item is the presentation of the audit, and to introduce that, let me turn it to Larry.
Yes, good morning, Mr. Chairman, member of the committee. Annually, the CalSTRS financial statements are required to be audited, and this year the audit was performed by Crowe Horwath. Excuse me, is that better? Okay, as required, these financial statements were audited by Crowe Horwath. It's important to recognize that these financial statements are prepared by management, and the role of the independent financial statement auditor is to express an opinion on those statements. And we have today with us representatives from Crowe Horwath, and I'm going to turn the time over to them to introduce the team to the committee and have Brenda Torres do that.
Thank you, Larry. Mr. Chairman, members of the Audits and Risk Management Committee, it's certainly a pleasure to be here. You might snicker when I tell you this is one of my favorite days, because it means tomorrow I get to sleep a little bit better. So I'm certainly thrilled to be here, and thank all of you for allowing Crowe to continue to perform services for the system. It certainly was a very interesting year with the implementation of GASB 67, as well as some additional procedures that we were engaged to perform to assist the employers with their implementation of GASB 68 next year. I certainly want to acknowledge not only the efforts of the Crowe team, but certainly all the members from CalSTRS that are in the room. They were very instrumental in providing us information on a timely basis, responding to all of our inquiries, collaborating about certain issues, especially as it related to the additional scope of some of the procedures. We certainly, collaborated with audit services as we designed our procedures to conduct the employer audits, to make sure that we did that in the most efficient and effective way. I also certainly want to thank everybody from CalSTRS who's in the room, as well as those that are hopefully watching today. So thank you. I guess one other thing before I move forward with the agenda, at least from my perspective, I believe CalSTRS is the first PERS to issue audited financial statements under GASB 67 and issue an audit, or Crowe to issue an audited opinion on these special purpose schedules that were recommended by the AICPA. So I think it's certainly something to be commended. It was done in a very short time frame. It took a lot of effort, and I think that's something to be proud of and acknowledged. Actually today, I'll introduce him in a minute, but we actually have our CEO here today, so he's going to open with some remarks. We'll then introduce the team that's with us today. I'm going to spend an extensive amount of time talking about the change in the scope of the engagement. I think it's going to be very important to set the context as to what Crowe is engaged to perform, because it's different than in previous years. So we'll try to correlate our audit procedures and our deliverables to the prior year, as well as then draw a distinction to what's new in the current year. And then we'll go through each of the deliverables, if you will. Oh, I went the wrong way. Oh, I did something. Oh, here we go. Apologize. Okay. So with that, I'm thrilled that as a partner of Crow, I think what I really like about Crow is that I asked our CEO to be here today to support us in our efforts, to acknowledge, CalSTRS and what an important client they are. And I just feel very grateful to you, Chuck, for honoring that request and for taking your time to interface with management and the executives as well as to be here today. So with that, I'll turn it over to Crow's CEO, Chuck Allen.
Yeah, thanks, Brenda. So, again, I want to thank you for the invitation, I guess, Brenda and the committee for allowing me to come here, but probably more importantly, I want to thank you for the support that you've given our commitment for Crow Horwath to being able to serve you as external auditors. This engagement does have high visibility within the firm. It has high visibility to me. And so it is something that, we take very seriously. I think, as I tell our people, organizations of public interest are higher calling. And so we have given this a fair amount of visibility within the firm and make sure that we have the right people on the job. I know you've got a lot to cover, but I want to talk a little bit about the tone at the top of Crow Horwath to give you a sense as to what that thinking is and how it impacts the people that we put on this engagement. So it starts with the value structure and our culture, and that all starts with the base of caring and sharing for our people. This in turn leads to an exceptional experience for organizations that we work with. For example, all of our partners participate in a national compensation system, and so irrespective to geography or business units, all of our partners work together as one team. And that allows us to bring together our people in a way that we can do our jobs irrespective of where people are located, both from a business unit or from a industry perspective or from an office. And it allows us to ensure a high level of audit quality as we bring those resources to bear. So with this business model and the framework, we've been able to staff the CalSTRS audit engagement with some of the best thought leaders in the firm, from the specialty areas of government accounting, employee benefit auditing, valuation of financial instruments, and IT security. So many of those people are sitting in the room today, and I will tell you that they're some of the best people that we have in the firm today. There are very few engagements that we have at Crow Horwath LLP where we bring the kind of partner talent that we brought to this engagement. And these partners and their teams have come from around the country to represent what I would call one Crow, to ensure the highest level of audit quality and an exceptional people for you and your people that work with us. So I know you have a full agenda to cover, and so I don't want to take a lot more time, but I do want to let you know that I believe that, again, public interest entities and the work that our audit people do on those are a higher calling than some of the things that other people within the firm do. And I have a high level of confidence after spending the time with our team yesterday and spending the team with some of your executive staff members yesterday. I have a high level of confidence in the work that's been done here and the quality of the audit that we've been able to deliver. So I want to thank you again for the support of our people. I also want to thank you for the support of your people in allowing them to work with us in the way that they do. I know all of you collectively have been through a significant process here over the last couple of months. And I will tell you, from the limited work that I was able to do yesterday and preparing on the way out here, I believe that you've delivered a very high quality engagement here. So with that, I'll turn it back to Brenda and the rest of the team to go through the results of the audit.
Thank you, Chuck. It means a lot. I want to reflect on one thing Chuck said. He talked about the power of Crow, and he talked about the tone at the top. And I think why we align well together is because I think CalSTRS has a very similar tone at the top. So just wanted to correlate that. I'm going to turn it over to Kevin to let him introduce himself. And I'm hoping Alexis can make her way up here to introduce herself as well. And then we'll let you know who else is in the room.
Hi, my name is Kevin Smith. I'm a partner
actually in charge of our governmental audit practice nationwide. I'm located in the Dallas, Texas office, and I've been with this engagement team since the beginning. So glad to be back and looking forward to our discussion today.
Talk out loud too. I'm Alexis Fitzpatrick. I'm a senior manager at the Sacramento office, and was on the engagement last year and took over a little bit of Jen Hour's responsibilities and really helped engagement management this year. And it's been a great year, and I appreciate your time and thanks for letting me be here.
Thank you, Alexis. And she said she took over a little bit of Jen Allen's responsibilities. I think she took over a lot of Jen Allen's responsibilities. If all of you remember Jen Allen from previous years, she's actually been elected as a partner of Crow. And despite providing the best talent and the number of partners that we have, we decided we couldn't have one more partner on the engagement. So Jen's working on some other clients now. I want to acknowledge who else we have in the room with us today. We might get here. Okay. Oh, he is here. So a couple of core people who really spend a lot of their time working with the investments business unit and overseeing our audit procedures over the investments portfolio. Chris Moore, a partner out of our Louisville office. He is the firm's valuation expert on a national level. Thanks, Chris. And then in addition to that, in the back of the room is Mike Van Dyne, a senior manager out of our Sacramento office that specializes in financial institutions and financial instruments. So he's here with us as well. And then, I'm not showing people's pictures. I apologize, so you can see. And then in addition to that, he's my wingman, Ron Gasink. I work with Ron, and I can tell you that every step of the way, he was by my side. His role and responsibility was to oversee and project manage the additional employer audits that we performed as a result of the implementation of GASB 67. So he had a very, very significant role. There's a number of co-resources that aren't here today, along with what Chuck articulated to you. Each of those individuals specializes in a particular area of this audit. For instance, and we'll talk a lot more about the employer audits, but Crow has a school district audit practice. So we pulled resources from that school district audit practice to conduct the employer audits from the Crow's perspective and to lead those engagement teams. And again, the point being that we're bringing the specialists within a particular industry to help us be effective and efficient in conducting those tests. So I'm going to start with the scope of the audit engagements and again try to correlate it to the previous year. So Crow was actually engaged to perform 2 separate and distinct audits. So similarly with the previous 3 years, we were engaged to audit CalSTRS, audit the system, for the year ended June 30th, 2014, so that's similar to last year. We conduct that audit in accordance with generally accepted auditing standards and government auditing standards, and so along with that, we are required to issue certain deliverables. One of those deliverables is the report on internal controls. In addition to that, management elected to follow the best practice guidance that was issued by the AICPA, and Kevin's going to cover that in much more detail. Management elected to prepare 2 additional schedules that are included in your annual financial report that you have. And those additional schedules, the purpose of those is to help the employers implement GASB 68 next year. So under the terms of the engagement, Crow was separately engaged to audit those additional schedules under the same auditing standards that I previously spoke to. So along with that, we also will be providing a report on internal controls on that separate engagement. We're going to spend a lot of time talking about the implementation of GASB 67. So GASB 67 significantly impacts the audit of CalSTRS. So you go from the unfunded accrued actuarial liability that was previously reported under GASB 25 to the net pension liability that's ultimately reported under GASB 67. And, one of the items or observations that all of you may have is, definition of a plan. If you go to the face of the financial statements and you go to the statement of the fiduciary net position, you will find that there is a single column for the STRIP, the State Teachers Retirement Plan. And that's appropriately reported by management as a separate and distinct plan. Embedded within that plan are multiple programs. And under GASB 25 in previous years, Management has disclosed the UAAL, or the unfunded actuarial accrued liability, of those separate programs in previous sets of financial statements. But again, those programs are part of a single plan, the STRIP. When adopting GASB 67, due to the accounting requirements of that in terms of the assumptions that were, I'll use the word mandated by the standard, 67 was applied to the STRIP as a whole. But in the context within GASB 25, as well as within GASB 67, as well as supported by the teacher's retirement law, it is a separate and distinct plan that has multiple programs embedded within it.
Can I just ask a question? So, are you saying that the decision in prior years under GASB 25 to show the components is something that is not an option under GASB 67, or that GASB 67 applies now, but a decision was made not to show the components?
I'll start and you can add. How's that? Okay. Mr. Chairman, in terms of addressing your question, I would tell you that the nature of plan is defined consistently between the two separate GASBs. What's significantly different is the variability and the assumptions that you can choose to apply to components of that particular plan, if you will. So for instance, as it relates to the DB program, in previous years and in the current year, entry age normal was the actuarial cost method that was used and applied. That is not consistent with that same method for the components within the STRIP, the CB, and the DBS. So when you look at 67, 67 requires the entry age normal, if you will. So I think it was appropriately applied at the level of the STRIP. And I'll let you.
I'd take exactly what Brenda said and just add that GASB 25 fundamentally was based upon an actuarially required contribution, so it was more of a funding nature. What does it take to fund the various plans in order to ultimately pay out the distributions? GASB 67 and 68 moved away from this funding approach and took a much more balance sheet focus. What is the net pension liability? So if we measured it today, what are the resources we have versus what we will ultimately pay out? So 25 being based upon a funding measure, and the fact that you had 4 different programs, all with different variabilities and different assumptions, it required the disclosures from a how do you get to the required contributions. 67 shifting to what is the net pension liability has taken that how do you get to the actuarially required contribution and ultimately just says what is the liabilities versus what are the assets for the entire program. So it's kind of a combination of what you said, Mr. Chairman, that 25 actually dictated that they provide that information on each of the programs. 67 basically dictates that they can't.
So, you were saying that entry age normal isn't really applicable to the DBS and cash balance plan, so how?
Not that it wasn't applicable. There are a variety of different things under the ASOP, or the Actuary Society. I can't remember what ASOP stands for, but there are a variety of different ways that the actuarial valuations can be determined. GASB 25 and 27 actually called for seven different measures as being acceptable. And then it was ultimately the plan's responsibility to determine which actuarial valuation was most appropriate in order to determine what the contribution should be. And as long as it was one of those 7, from a GASB or a GAAP reporting standpoint, it was deemed acceptable. 67, one of the ultimate goals of the GASB was to try to make plans more comparable, or the financial statements more comparable between plans. So they tightened the reins and said no longer are we going to have 7 different actuarial valuations acceptable. We're going to say that you have to have it performed under entry age normal. So you may still determine what your funding should be on a projected unit credit or a variety of different actuarial valuations that are sound from a funding perspective. But in order to compare liabilities across plans, we're going to require you to use one, and that's entry age normal.
So in the past of the 4 programs that Ms. Torres referred to, you had a variety of different actuarial or a variety of different methodologies. In the current year, it's just the entry age normal.
And so so if you were to still disaggregate the strip into the component parts using consistent methodology, entry age normal on all of them, would that give us anything? I mean, why don't we do that? Why don't we still show the component parts?
That comes back to the gap definition of what a plan is, and both management's interpretation of the plan as well as our interpretation of the plan, not from necessarily a legal standpoint, but how generally accepted accounting principles would define a plan. We believe that the appropriate level of what is the plan is the strip.
And has that changed now because of 67? Because that
It has not
was not
changed,
the-
and it's not changed
Okay, but
because, and the way that I would point to the fact that it hasn't changed is in the past, you had one column within your balance sheet and your income statement. I know I'm not using the exact right accounting terms, but a balance sheet and an income statement, you had one column for the strip. You continue to have one column for the strip, and that's because management has deemed, help me, Robin, the legislation in 1998? 96 established the state teachers' retirement plan as the plan of the system. So beginning in 1996, that's when they moved to one column, and so 67 hasn't changed that. It's the disclosure within the footnotes as to how the liability is determined that has changed.
Yeah, okay, and so, and why is that? Why has there been a change in the disclosure in the footnotes?
Because again, it's shifted to a balance sheet approach, so it's just to determine what is the ultimate liability of the strip, where previously the focus was what are the actuary required contributions to the plan. So although the unfunded accrued actuarial liability was presented, the focus of the statements was in determining what's the amounts that should be contributed. And in order to determine the amounts that were to be contributed, you had to look at each of the 4 plans separately. Programs, thank you.
Okay, not sure I fully understand. I don't know. Others, Arena?
Yeah, I was just gonna ask you to repeat that point that you're making, because that's where I'm hung up on, is when you actually display the liability, and if you're putting all the funds together, all the programs together. I understand the point you're making about the plan, the definition of plan, but when you use all of the programs to assign the liability, then it appears as though that one could look at their liability as being offset somewhat by other programs that are not connected to those actual liabilities. So if you're a district looking at your liability and it's being, this is probably not the right word, but subsidized by the cash balance or DBS program because that's part of the plan. So the first point you made about what the previous statement was addressing and what the current statement is addressing, if you could repeat that and help me with that a little
I
bit.
can try to just address what you just said and see if this helps. The definition, there are 3, the GASB basically defines 3 types of plans: a single employer, a cost sharing, and an agent multiple. CalSTRS is deemed to be a cost sharing. And one of the ultimate reasons for that is because the cash of the plan is fungible and can be utilized to pay any benefits that come due. Our interpretation, or management's interpretation of the strip, or the teacher's retirement, as well as Crow's assessment of management's assertion, is that the entire, if you pull all of the programs into the plan, it is still cost sharing. Ultimately, if an employer was to exit the CB program, it would probably go through a legal process to determine whether or not they had to make additional contributions. We're not aware that anything like that has ever occurred, nor has a legal opinion been reached. But based upon our interpretation of the strip, it's a cost-sharing plan. So the unfair subsidies that you're talking about, at least from a GAAP perspective, it does kind of have that embedded within it. But again, it's an estimate of the ultimate liability that will be allocated to the employers. It's not an exact number of what they're legally obligated to pay. It's accounting.
Just as the representative of management here, this point was refreshed in my view, in that I went back and looked at GASB 25, just because, we'd been following GASB 25 for 10 years or so. And so I went back and looked at it, and it really starts out from a funding perspective. And that really is the significant change in the new GASB statement, is it is pushing that funding perspective aside and saying we're establishing a new set of standards that really don't relate to funding. It's just for accounting purposes. And so it's that, and we're in a period of transition, so it's a very difficult change to make from a thought process. We're used to the alignment of the financial reporting to the funding. And that was promulgated as a part of those original standards. But these standards are deliberately, in my opinion, breaking that link and creating a new methodology with, again, in the seat that I sit, and the arguments that we made with GASB through the hearing process was a deliberate action to say it's not funding. We're going to create what I think of as a completely different measure, with the purpose of making sure that measure is comparable across plans. That was really one of the primary goals.
Yeah, I guess what I appreciate your, this is just for accounting purposes, but I mean, what we hope is that accounting helps us understand the reality out there, and I guess the concern that I have is I understand everything you're saying, but I have a hard time understanding how the legal definition of a plan that incorporates these three components can, when trying to measure liability, combine three programs for which the responsibility and liability is allocated differently to the participants in the plan. And that's why it makes it very difficult, because especially when at the same time we then move to GASB 68 and we say, okay, now we're allocating these responsibilities out, but seemingly not allocating these responsibilities out with consideration for the individual employer's responsibility for the DB liability relative to the cash balance liability, relative to the DBS liability, and maybe there's no way around that problem, given the accounting rules. But I would think we would try as much as possible to avoid that problem in the implementation of these rules.
But doesn't that stem from your construct that it's about responsibility to pay? I mean, that's the problem. It's a different question that's prompting your concern, which I think is the very problem we raised with GASB, which is, isn't this, it's not taking us to a better point of clarity. It's creating a new body of confusion for the sake of something GASB wanted for reporting. But if you start with exactly that's the hardier question to answer, but this GASB requirement doesn't seem to
I
point
agree
us
with
that
you.
way.
I mean, that's why I'm sort of asking the question. I'm saying, okay, so GASB pushed us in a direction that seems to not really help us get clarity about what we think are important issues.
That's right.
So, given that, how far can we push the interpretation and implementation of these GASB rules to still give us something that makes sense to us and would make sense to the 1,500 districts when they take a look at that schedule? That's all.
Fair, yeah. I think you feel our anguish too. We've never been pleased with where this takes us from a communication tool to the outside audiences, that's true.
Yeah, and I want to underscore that all of the, there was a community of discussion around this at the point of implementation, and we've had to put that aside and understand and implement the standards as they were promulgated, even though a lot of plans and a lot of voices were heard that said, this doesn't necessarily make business sense, it's not operational, it's not actuarial, it is a concept that's intangible because we can't relate it to any particular thing that we do. I mean, those were all embedded in the conversations that we had, but in the issuance of the standards, for reasons that I think all of us will not all understand all of, this is how the standards came out.
And this is both management and the auditor's interpretation of how we have to implement it to see the whole strip as a single plan.
Yeah, and there's a section in law, Paul, that, and I'm not the lawyer, but this is the sentence that really underscores the definition of what I call the strip, the State Teachers Retirement Plan. And it's a paragraph that really was designed because originally the plan was the system and it only included the DB program. And then there was a change in law whereby these two plans are now hereby made for the purpose of establishing a single retirement plan that shall be known and may be cited as the strip, consisting of the different benefit programs set forth by this part and Part 14, commencing with Section 26,000. This plan shall be administered by the Teachers Retirement Board as set forth in this part and Part 14. This part, together with Part 14, which is the CB program, shall be known and may be cited as the Teachers Retirement Law. So that language in statute really sets the framework for the definition of the strip as a combination of those programs.
Thank you.
Mr.
Any other
Chairman.
questions on that matter before we go on?
Mr. Chairman, I'd just like to add and to echo some of the comments that Jack made. I think the struggle is the funding of the plan is determined by state statute. So you can't change the funding. So that determines which each of the employers, the members, the state are required to contribute to the plan. All of those contributions are commingled and can be used to pay benefits within all of the programs within the plan. And ultimately, it is a financial reporting standard that the GASB was trying to come up with a way so that each of the employers had a reasonable basis for how they can report their portion of that liability in a cost-sharing environment.
I think you just triggered a question from Morena.
So the question about the plan and the funds being fungible, and you can use the funds to pay any of the benefits of any of the three programs. So I think I can understand that argument from an accounting perspective, that you don't have to isolate pots of funds to pay benefits out of particular accounts, that you can have it all together in one account. But from a legal perspective and the obligation of the plan sponsors, if one of those funds is not solvent, the fungibility question is different then, because then you're talking about the obligation. So does making these accounting statements somehow make a statement about the ability to use one fund to pay for one program to pay for another, should one of them not have enough actual funds available?
So I'll have to chime in here. I think that question is beyond this panel, and actually it's a presentation that we're setting up for February about the legal responsibility. I would, though, echo what Brenda said about this doesn't change the law. This doesn't change. When we look to who's responsible in the allocation, we look to the code, we look to California law. This does not transmogrify California law at all. It's just a thing that exists for some purpose that is not legal.
Yeah, but I think the question that in my mind was raised by what Brenda just said, and maybe we're misunderstanding what she's saying, but if the fact that dollars are fungible and any program can support a shortfall in any other program, if that understanding of state law is what underpins the determination that the strip is a single program, then I think we've got a question. Because, do you see what I'm saying? I mean, if there's an accounting reason to think that these components are a single plan, we can understand that. But if that accounting interpretation arises because of an interpretation of the law that says that the dollars from one component are available to pay shortfalls in another component, if that's what leads to the conclusion that it's a single plan for implementation of these accounting standards, then I think we have to answer the legal question before we can determine that they're a single plan for purposes of the accounting standards.
I do have a comment here that I don't know if it's going to help the discussion, but it does clarify the accounting approach to those reserves, which we do address, and it's on ARM 39. So we are legally required to disclose certain reserves held in trust for the payment of the DBS and the CB and the SBMA. So again, I think part of the issue here is one that we all expected, in that communication and understanding is difficult because there is the creation of a accounting view that is not how we operate or how we fund. But we still do maintain reserves for program purposes as legally indicated, and that as well has been disclosed.
What page?
So I'm on ARM 39, which is page 34 of the, hopefully I've got the right pagination.
Page 34 of the audit?
ARM 39, 34 of the audit.
Of the financial statements. So there you see in the middle of the page, the reserves that are set aside within our,
Okay, well, I think, again, reserves are, the question is a reserve for one program available for another program, or are they restricted? And I think we'll look forward to the legal feedback, because I think, at least in my mind, it's unclear still whether this reflects a legal interpretation or not, and or is consistent, can coexist with a legal interpretation that is different than the way Brenda just described things.
That's fair, and I'm not sure there's gonna be full harmonization here. I think that's what you're looking for in all, between legal, funding, financial reporting. That may be a goal that's not achieved, but we want to understand each piece of it for sure.
Got it.
And I think, at least I think management and our auditors are on the same page that this was the right path to take with this, but.
And I think what it raised is whether this, we I think need to know whether this embodies a specific legal interpretation or not, and what that is, if it does. If it doesn't embody a particular legal interpretation, but is merely the implementation of accounting standards, then that's fine too. But I think we look forward to more information to get a full answer on that. I don't know, Bob, you've been very silent here. I don't know if you have any thoughts to help us.
For good reason, Mr. Chairman. My advice is to wait on the legal interpretation. It's, as has been stated, management and the auditors have come to both simultaneously the belief that this is the correct implementation of an accounting standard. And from GASB's perspective, put yourself in those people's shoes. It's a very complicated issue that they took upon themselves, and they can't drill down to the specific legal implications that this will have on every fund and every organization. And so they opted for what they thought, we call this second best all the time. This is not the best outcome, clearly. But maybe it's the best they could do given what they had. But your question, I think, is quite a good question, which is, nonetheless, is there, by making this decision, does that, or how does that, to what extent does that reflect upon other beliefs that may be had about obligations? And I think that's a valid question.
Clarifying, well, maybe this is the answer to the question is more appropriate for the February conversation, but since I wasn't here for the SCR 105 discussions that the board had, when you look at the reserves on ARM 39, there's the $10 billion in the SBMA. But that was not considered as available to offset the unfunded liability, right? So, I mean, it kind of seems like the opposite of the argument, that those funds were not available in that discussion, but in this discussion, all the funds are available to each other. So that's kind of confusing and maybe something to, so.
That is absolutely the contradictions of these. I think I'm gonna send a copy of this videotape to GASB, because we're the first ones out of the blocks on this. And it would be nice for them to see what happens at the finish line. Seriously, just so how do you process this into real life, and then what does it tell your stakeholders? What does it tell funding authorities? Because we talk so much about potential confusion from these things, and we get the questions, so we really do.
Well, and I think staff has told us of the confusions that were coming in until we saw this. Maybe we didn't fully understand that either,
I know.
so.
I know. I think they would like the videotape. That's my thinking. I think it'd be good for them.
Sorry to interrupt. Go back to your presentation.
Mr. Chairman, our pleasure. Interrupt all you want. That's why we're here. Wow, it's going to be hard to get through these next few slides, I have to tell you. To kind of recap the conversation, I feel like teachers' retirement law governs how the plan operates. I think GASB and GAAP govern the financial reporting as it relates to the plan. A couple of statements that were made relative to this, and I think I want to try to draw a distinction, is that I feel like there might be a perception that CalSTRS is determining each of the employer's liability. So each of the employers and the non-employer contributing entity. I think what CalSTRS is doing is they're following GASB and GAAP. They're computing the net pension liability of the strip, and then they're providing a mechanism that would allow the employers to set their own interpretations and their own accounting policies for purposes of determining their proportionate share of the liability. So with respect to CalSTRS financial reporting and these special schedules, I think that's the intent of that, and they did follow the recommended best practice guidance. So I know it's been said a little bit differently, and I wanted to try to clarify that. So GASB 67, has a significant impact on 68 for each of those contributing entities. I think we've spent a sufficient amount of time with respect to correlating the prior year to the current year, with one exception. And I think one exception to that is that we either participate in webinars with management. They did road shows as it related to GASB 67 and GASB 68, trying to educate the stakeholders that ultimately we're going to bear the burden of determining their net pension, their proportionate share of the net pension liability. One of the items that I wanted to reflect on is that prior to the passing of Assembly Bill 1469, management was communicating in each one of those conversations that the net pension liability would be somewhere around $167 billion or so. So as it relates to the numbers that you're seeing in our financial reporting, you're not seeing $167 billion. And the reason for that is a direct correlation to the passing of that Assembly bill before the end of the financial reporting period of the plan, that allowed the impact of those future contributions due to the increased funding, which ultimately reduced the net pension liability of the strip. Management's going to go through tomorrow a very detailed presentation to walk you through this chart that you see right now in our slides and to take you through the UAAL as of June 30th, 2012, all the way to the net pension liability as of June 30th, 2014. So I'll let Robin and her team handle that
Yeah, and-
tomorrow.
Yeah, and we do have those slides here as well, if that's something that you would like us to do in this setting. So I'll leave that to the committee's discretion.
I don't see anybody clamoring for that now.
We'll do it tomorrow.
Okay, I'm going to turn it over to Kevin.
Thank you. Brenda has gone over quite a bit of this impact of GASB 67, but I would point out two key points on this slide. One, what ultimately drives the 58.4 billion that was identified is the assumptions embedded within the actuarial valuation, as well as the completeness and accuracy of the census data. They both have a significant impact upon that ultimate liability. Later on in our presentation, we're going to talk about our audit approach as it relates to the test work as it relates to the census data. That was new or it was expanded in the current year. I think there is a lot of confusion within the industry as to what the purpose of that test work is. It does in fact allow kind of this byproduct schedules that we're going to talk about that the school districts can rely upon as part of their financial reporting process, but ultimately this NPL is also included within your financial statements. So this test work on the census, on the completeness and accuracy of the census data actually exists for CalSTRS prior to it existing for the actual school districts or the employers. Brenda also pointed out the passage of AB 1469 as being a key critical component. And I'm going to tell you that that's because it allowed you guys to continue to use the 7.6% long-term rate of return that the board has established. Some people might remember the 7.5 versus the 7.6, but that small difference is due to the admin expenses and how the GASB defines what the long-term rate of return is. Prior to 67, an entity could have said, I'm going to establish a long-term rate of return of X and still been on a pay-as-you-go basis, which the GASB said didn't make sense, so they kind of came up with this concept of a crossover date. So we're going to flash forward over the next 30 years and try to predict what your statement of fiduciary net position is going to look like. And if ever turns into a negative or a cash pay-as-you-go basis, then you have to use the AA municipal index rate to arrive at a single blended rate. Everything that had previously been disclosed or reported by management as to what they thought the impact of 68 was going to be, this 176 billion that Brenda referred to, that went away with the passage of AB 1469 because of that. The future contributions are sufficient to keep you out of a pay-as-you-go basis at this point in time. A couple other kind of behind baseball or behind the scenes that has happened over the last 2 years. I think it's important to recognize that the GASB issued these two statements in June of 2012. It wasn't until February of 2014 that the AICPA actually issued their recommended guidance as to how to deal with this. And it wasn't because it wasn't top of mind on the AICPA's expert panel list of things to address. This is just this kind of complicated. I loved the message that Dr. Yetman tried to deliver. If you've seen one PERS, you've seen one PERS. And the GASB really struggled with trying to come up with generally accepted accounting principles that would address all of the multitude of plans. The AICPA realized, much like that, it's very difficult to address all of the accounting and auditing considerations, both for the plan as well as the employers. They did develop two white papers, though, that ultimately address what they expect both the management of the plan to do, management of the employer, auditor of the plan, and auditor of the employers, and it's embedded within these two white papers. The two white papers, although one could consider to be best practices, are linked to 3 auditing interpretations. So in fact, it's grounded within generally accepted auditing standards. And probably the key point is this interpretation number 2 that basically says for a cost-sharing plan, the audited financial statements of the plan supplemented by non-audited information isn't going to provide an employer's auditor sufficient evidence to render an unmodified opinion if the amounts are material. Clearly, the amounts that are going to be allocated to many of your employers are material, and recognizing that just the audited financial statements weren't sufficient, management opted to engage Crow to follow these best practices. It doesn't dictate that these are the numbers that will ultimately be included within the employer's financial statements, but it does provide a basis for what they believe the amounts to be. There are actually certain amounts that are, from an employer perspective, when contributions are made in relation to the measurement date, and not to get too technical, but the numbers that they will ultimately record aren't going to match what you've included within your schedule. But it does provide a basis for the employer's financial accounting as well as the employer's auditors to begin to address the amounts that will be included.
I'm going the wrong way again. I want to add on one comment that Kevin made here that's significant to the scope of our work, and we'll talk a little bit more about that as we go through our interpretation, or I'm sorry, our presentation. It actually has to do with the third bullet, interpretation 1. And the key element associated with that is the standard as to which we're issuing an opinion on those special schedules, if you will, that the employers and the employer's auditors may choose to rely upon. Under interpretation number 1 of AUC 805, it requires us as auditors to establish materiality, and in this case, we established materiality for the schedule proportionate share as a whole, as well as for specific elements on the schedule of aggregate pension amounts. And we'll get to that in a little bit more detail, but I wanted to make sure that these interpretations, that additional interpretation is very important to our audit approach and some of the findings and items that we'll cover throughout our presentation.
Thank you, Brenda.
So as Kevin stated, we want to make sure there's not a misperception of the additional scope of work that we performed in the current year, which resulted in performing substantive testing at employers that contribute to the strip. So embedded in the guidance, we would have been required as auditors to perform those substantive procedures in the event that management chose not to prepare these additional schedules. So first and foremost, the purpose of performing testing over the completeness and accuracy of the census data and focusing more so on the active census data as we went to the employers was for purposes of the disclosure in the financial statements for the total pension liability of the strip. In addition to that, our testing at the employers served an additional purpose, and that was to help us perform additional substantive procedures to get comfortable with the amounts recorded on the schedule of proportionate share, which was based on accounting policies established by management with respect to which contributions would be included in those schedules and how those contributions would then be allocated to the employers. And what was challenging with respect to all of this is that the census data, or the valuation date that's used to determine the total pension liability, is as of a June 30th, 2013 date. So we're looking at the prior year information as it related to the census data. And then that census data is rolled forward to June 30th, 2014 for purposes of calculating the total pension liability and reporting it in the plan's financial statements. As it relates to the contributions and the funding mechanism that's used to determine contributions, the state's contribution is based off of credible compensation earned, in this case, in fiscal year 11-12. And the employer's contributions are based off of credible compensation earned in the current year, in this case 13-14. So the significance of the test work was certainly to support the total pension liability, the completeness and accuracy of that census data, but it served a dual purpose and helped us to perform additional procedures over the schedule of proportionate share. Embedded within the white papers that Kevin spoke to was recommended guidance on a sampling approach. And that sampling approach was really based on an employer's proportionate share of covered payroll or credible compensation. So within this slide, that's been identified into 4 different buckets. Employers that have credible compensation on an annual basis greater than 20% of the total covered payroll. Those employers with covered payroll between 5 and 20%. And then those employers that are deemed to be completely insignificant, so in the aggregate less than 2% of covered payroll, and then you have a 4th bucket that includes everything else. The purpose of this is really to look at coverage and look at risk, and in addition to that, establish a methodology. As auditors, we never audit 100%. We certainly apply a sampling basis. So using this guidance to segment the employer population, we then followed the recommended guidance and set our sample sizes based on the rotation that was recommended. So those very significant employers, which the strip has none, would be audited on an annual basis. Those that fall in the next tier would be audited perhaps once every 5 years, the next tier once every 10 years. And the recommended guidance actually said that the additional employers that in the aggregate represent less than 2% of total covered payroll may never be subject to audit. Now, I can tell you, I'd like to think that Dr. Yetman thinks I'm a good auditor. In my opinion, every employer has to have the possibility of being selected. So therefore, in our professional judgment, we made sure that we selected employers that were in that less than 2% bucket. What that resulted in is here's the total number of employers that we calculated. And again, this is as of June 30th, 2013. And here's the sample size. So we went and performed 100 employer audits in conjunction with CalSTRS Audit Services. We combined our teams to go and perform these substantive procedures. The focus of our testing really related to the completeness and accuracy of the census data. So you're looking at demographics, you're looking at eligibility, you're looking at the calculation of covered payroll. You're making sure that there aren't employees of the employer that have been improperly excluded from participation in the strip, if you will. And so that was the focus and the nature of our testing. The distinction that I want to make is that the employer audits group embedded within audit services of CalSTRS, the objectives and the focus of their employer audits is a bit different. And so I think it's important for you as a committee, an oversight committee, to understand that there is a clear distinction between our work that we perform for substantive purposes so that we could opine on the total pension liability and ultimately the financial statements of CalSTRS versus the objectives of Larry and his group in purposes of performing the compliance audits. So once we get done with auditing CalSTRS, if you will, we want to talk about the special purpose audit. So again, management elected to prepare 2 additional schedules based on the recommended guidance. And Crow was then ultimately hired to form an opinion on those schedules. This is really hard to see, but basically the schedule that was recommended in the guidance, I believe, is called the schedule of employer allocations, but the schedule of proportionate share is also very appropriate. And here's an excerpt of the schedule that is, 40 pages long within the annual report.
Made the weight, the scale.
Okay. ARM 76, if you'd like to refer to this schedule, is the page number that you can refer to. And in addition to preparing the schedule, this is considered a financial statement. So in addition to preparing the schedule itself, management was also responsible for drafting notes to the schedule. And within those notes discloses the accounting policies that were used to determine the contributions, the policies associated with the rounding and the percentages allocated to each employer, as well as how the schedule itself is organized, so that as an employer and the user of this financial statement, you would have an idea as to how to find yourself and to see what information CalSTRS was providing to you. In addition to that, CalSTRS also prepared a schedule of aggregate pension amounts. And in this particular case, when I was referring to our opinion previously, under AUC 805, it is our responsibility to actually issue an opinion and assess materiality on 4 components within this particular schedule: the total net pension liability, the total deferred inflows of resources, the total deferred outflows of resources, and then total pension expense. And each one of those components are separately stated on this particular schedule. And those components will be very instrumental to helping each of the employers come up with their journal entries to book their liability to the extent that they choose to use these schedules to do so.
Brenda, if you'd go back one slide, just to kind of put this into perspective, the auditing, there's going to be a new auditing chapter on what the employer auditors should do within the state and local audit guide.